Hello everyone, welcome back to Fundrise Finance. Since hitting the recent market lows on middle of October, the S&P 500 has had a nice good rally of over 6% just in the last 2.5 weeks. If you look at the 1 month performance of all the gig sectors, we see energy performing the best in the last month of over 10% performance. And after that, industrials almost 10%, likewise financial and consumer defensive almost 9%, materials and healthcare almost 7%, followed by real estate just over 5%, and utilities 4%. Technology, consumer cyclical, and communication services have been the down performers. So with this recent rally in the markets, many of the well sought after stocks, which have been at a very good valuation so far, have suddenly gone overvalued. The financial sector is a classic example. JP Morgan rallying almost 24%, Bank of America over 20%, Honeywell over 22%, McDonald's rallying almost 19%. These are just few examples, but the goal of our investing in this channel is to pick undervalued stocks. Buy stocks when they are at a very good valuations. Let's look at 5 set stocks which I feel are very undervalued at the moment and offer a very good buy. Let's check it out. But before checking out our November stocks, let's give a quick look at how our October picks did. Last month we had Air Products and Chemicals, BlackRock, Coca-Cola, Lowe's companies, and Procter& Gamble. So apart from Lowe's, all the other four have really done good in the last month. We see BlackRock returning almost 23% in just 1 month. Air Products, almost 20% return. Coca-Cola and Procter& Gamble, over 9%. Now let's take a look at our November dividend picks. The first stock on our list is Abbott Laboratories, ticker symbol ABT. Abbott is from the healthcare sector that develops, manufactures, and sells healthcare products worldwide. Year to date, we see Abbott falling almost 28.5%. In the last 1 year, a negative performance of almost 22%. In the last 5 years, we see an impressive performance of over 80%. Likewise, in the last 10 years, we see a return of over 220%. Abbott Laboratories has a market cap of $170.99 billion and currently yields 1.92%, the forward PE of 18.86. From dividends perspective, Abbott has been raising its dividends for the last 9 years at a very good 5 year growth rate of 12.14%. That means it's better than the current inflation rate, which means your dividends don't lose their value to the inflation. A very good payout ratio of just over 33%. Morningstar considers Abbott a 3-star stock with a fair value of $104. Value Line has a midpoint target price of $132, while CFRA has a 12-month price target of $110. As for my own calculations, which considers current and historical dividend yields, I calculate Abbott to have a fair value of $120.54. Averaging these four values, we get an average price of $116.64. That makes Abbott currently undervalued by 17.22%. The second stock on our list is Cisco Systems, ticker symbol CSCO. Cisco is from the information technology sector that designs, manufactures, and sells internet networking equipment. Year to date, we see Cisco falling almost 30%. The last 1 year, a negative return of almost 22%. The last 5 years, we see a positive return of over 29%. The last 10 years, almost 157% returns. It has a market cap of $182.83 billion and currently yields 3.41% with a forward PE of 12.64. From dividends perspective, Cisco has been raising its dividends for the last 11 years at a 5 year growth rate of almost 6%, with a payout ratio of almost 45%. From valuations perspective, Morningstar considers Cisco a 4-star stock with a fair value of $54. Value Line has a midpoint price of $54, while CFRA has a 12-month price target of $60. As for my calculations, I found Cisco to have a fair value of $50.32. Averaging these four values, we get an average price of $54.58. That makes Cisco undervalued by 22.51%. The third stock on our list is Lowe's Companies, ticker symbol LOW. Lowe's is from the consumer discretionary sector and is a home improvement retailer. Year to date, we see Lowe's falling almost 27%. The last 1 year, we see a negative return of almost 20.5%. The last 5 years, though, we see a positive return of almost 139%. The last 10 years, a positive return of almost 463%. Lowe's has a market cap of $113.06 billion and currently yields 2.31% at a forward PE of 13.49. From dividends perspective, Lowe's has been raising its dividends for the last 59 years. That makes it a dividend king, which is an exclusive group of companies who have been consistently raising their dividends for more than 50 years. It has a very good 5 year growth rate of 19.47%, which is like more than double that the current inflation, and a very low payout ratio of just over 27%. These are amazing stats. From valuations perspective, Morningstar considers Lowe's a four-star stock with a fair value of $212. Value Line has a midpoint price of $238, while CFRA has a 12-month price target of $230. As for my calculations, I found Lowe's to have a fair value of $238.87. Averaging these four values, we get an average price of $229.72, which makes Lowe's undervalued by 23.13%. The fourth stock on our list is Medtronic PLC, ticker symbol MDT. Medtronic is from the healthcare sector that designs, manufactures, and sells healthcare equipment to clinics and hospitals worldwide. Year to date, we see Medtronic falling just over 19%. In the last 1 year, we see a negative return of over 30%. In the last 5 years, a positive return of almost 10%. Medtronic has a market cap of $112.51 billion and currently yields 3.21% at a forward PE of 15.3. From dividends perspective, Medtronic has been raising its dividends for the last 8 years at a 5-year dividend growth rate of 8.04% and a payout ratio just over 48%. From valuations perspective, Morningstar considers Medtronic a five-star stock with a fair value of $129. Value Line has a midpoint price of $106, while CFRA has a 12-month price target of $112. As for my calculations, I found Medtronic to have a fair value of $112.17. Averaging these four values, we get an average price of $114.79, which makes Medtronic undervalued by 34.2%. The fifth and final stock on our list is Microsoft Corporation, ticker symbol MSFT. Microsoft is from the information technology sector that designs, manufactures, and sells computer software and hardware worldwide. Year to date, Microsoft has taken a real beating, falling almost 32%. In the last 1 year, it has fallen over 32%. In the last 5 years, though, a very good return of almost 170%. In the last 10 years, an amazing return of over 690%. Microsoft has a market cap of $1.65 trillion and currently yields 1.23% at a forward PE of 23.21. From a dividends perspective, Microsoft has been raising its dividends for the last 17 years at a 5-year growth rate of 9.71% and a very low payout ratio of just over 27%. From valuations perspective, Morningstar considers Microsoft a five-star stock with a fair value of $320. Value Line has a midpoint price of $334, while CFRA has a 12-month price target of $330. As for my calculations, I found Microsoft to have a fair value of $253.39. Averaging these four values, we get a final average price of $309.35, which makes Microsoft undervalued by 35.76%. To summarize our picks for the month of November, we have About Laboratories, Cisco Systems, Lowe's Companies, Medtronic PLC, and Microsoft Corporation. Like we just saw, each of these stocks is undervalued by more than 15%, with Medtronic and Microsoft currently undervalued more than 30%. I feel each of these five stocks are a very good picks right now, which one should capitalize upon. So, irrespective of whether the market is up or down or sideways, as long as we buy stocks that are undervalued, these stocks will provide a great return in the long run. That's all I have in this video. If you all liked it, and I would really appreciate if you could hit that like and subscribe button so that YouTube can suggest this video to many more people out there, and that would help this young channel. And until we meet in the next video, let's try to do as much as possible to be financially healthy. See ya.